I hope this finds you well wherever you are. This is Carrie Meath-Sinkin with Meath Wealth Advisors. And today I wanted to share with you just a few thoughts of how history can help inform our present situation. Really, in this case, looking historically at what has happened during presidential election years and the impact of that on the stock market. So I'm just going to share with you a few quick slides to go through some ways that we can look at the past to help inform the present and maybe help give us some context for how we think about things and make decisions moving forward. So here we go. This first slide shows us that stocks have continued higher regardless of which political party holds the presidency. So what you're seeing is starting in 1926, and those yellow bars represent Democrats, the red bars represent Republicans. And what you can see is regardless of which party holds that office, stocks have continued to go up. So this maybe just gives us some thoughts on how we're viewing things. Here, we're going a little bit deeper and we're saying that it's time in the market that matters. It's not necessarily which political party holds the presidency. So on the left, you're seeing over the last 10 years, what a return if you invested $1,000 would be both if you were invested the entire time or just when a Republican or just when a Democrat held the presidency. And what you can see is not surprising that it's staying invested. You would have done significantly better. On the right-hand side, you're seeing that over the last 70 years. And what you're seeing is a very, not just a little bit, but a very significant difference. So you're seeing that if you were just invested when a Republican held the presidency, you'd only have about $31,000 versus about 50 if a Democrat held the presidency versus the impact of staying invested. You'd be at around 1.58 million. That's significantly better. So this can just give us some information from history to say maybe staying invested is a better idea. What you're seeing here is just the impact, the averages when during presidential election years, midterm election years, and non-election years. And it's not surprising that non-election years, stock markets tend to do a little bit better at 14.8% compared to election years at 11.6, midterm election years at 7.4, and then the average since 1926 at 10.3. What this next slide is showing us, I think, is really interesting. And what you're seeing on the left is the percentage of Americans satisfied with how things are going. And you can see this going back all the way to 1979. And what you can see is that it's obviously gone up and down, but right now satisfaction levels are pretty low. What you're seeing on the right is historically what has happened when satisfaction levels are low over the next 12 months in the stock market. And you're seeing that kind of interestingly, that when Americans are less satisfied, under 33%, the stock markets over the next 12 months tend to do better than when Americans feel more satisfied. So I think this just points to, how we're feeling sometimes isn't going to be the best indicator of how we invest our dollars if we look at historically at what has happened. If we look at this next slide, you're seeing the decisions that people are actually making during presidential election years. And you're seeing that investors tend to build up cash. You're seeing that those red bars represent election years, the yellow bar, especially on the left, representing a non-presidential election year. And what you're seeing is that more dollars go into money markets during presidential election years, whereas more money tends to go into stocks and bonds in non-election years. And so here, what you're seeing, I think, is that uncertainty playing out, is when we aren't feeling sure, we're feeling nervous about which political party might hold that presidency, we're making decisions accordingly. And while we never know what's going to happen, we never want to let the past predict the future. We can look at this as historical information to maybe give us some guidance about how we're viewing things now. And so from our standpoint, we use this to say, your goals, understanding you and what's important to you over the next 1 to 3 years, over the next 1 to 20 years, or 1 to 30 years is really what should drive your investing decisions and how risky or how conservative you're invested, not necessarily which political party holds the presidency. So I hope these slides were helpful. As always, we are here and happy to help you anytime, so please don't hesitate to reach out. Thank you so much and have a great day.